Hello everyone, Manny Gomes here. I want to put together a quick video explaining the why behind the market and what has created this recent increase in mortgage rates. In front of you, you will find a chart of the mortgage-backed security Fannie Mae 30-year coupon. And this chart is a 2-year chart that shows what has occurred in mortgage-backed pricing in the last 2 years. There's an inverse correlation between the pricing of these mortgage-backed securities and rates. So the higher in price we go, the lower the rates. So as you can see right here, this last 30 days, bonds have taken a bashing. We have lost close to 500 basis points, and this is correlated to almost half a percentage point increase in rates. Now if you see here, we have now hit a pretty good floor of support. And if I zoom in to a shorter window period, bear with me, you'll see that yesterday and today we have reversed course and are starting to head higher. Now, if this should continue, our rates will gradually come back down a bit, but it's pretty safe to say these levels here may not be reached again. We will need some horrible economic data coming out, or of a geopolitical crisis for bonds to reach these levels once again. And what made this happen? It was our friend Ben Bernanke and the Feds. They have been hinting to the market that in the near future, depending on the economic data, they may actually taper their bond buying program. Currently, they're buying $85 billion in mortgage bonds per month, and if they hint at tapering, what's going to occur would be the institutional traders, mutual fund traders, and hedge fund traders will start shortening their bond positions ahead of the Fed's exit, because they want to protect the gains that they've received. This means going forward, rates will gradually head higher. That's not going to happen in sync. It's not going to be an eighth each month going up to a certain point. It's going to be range bound. As you can see from the year chart, just to make things a little easier, there's an ebb and flow to the mortgage bound market. There's sell-offs, and then there's buying periods, and it's just traders taking profits, looking for entry periods, and also the seesaw effect between stock market and mortgage-backed securities. Generally, as stocks improve, bonds get hurt. As you can see right here, stocks have improved, bonds have sold off. This period here was a little bit of an anomaly. Not really sure how to explain this one, but as we can see, the last month the bonds have lost close to 6% in price, and the S&P was up 3%. So that tried and true seesaw effect took place here. What I think is going to occur, I think this equity rally is a little overblown. I think this sell-off here was definitely overblown, and we're going to see stabilization, and rates will probably remain range bound between 3 3/4 and 4 1/4 for the remainder of this year. Now, how do we counsel our clients around this? Well, if we have clients who think rates are going to head back down to those levels because they've done it in the past, this may be one of those periods where they're going to get burned, and going from 3 1/4, their wish rate, to 4 1/4 is going to impact not only their purchasing power, but it's going to greatly impact the monthly payment. So right now, the best counsel to give our clients would be to take action, and if the buying opportunity is there, just sign a contract and get underway, because they are not going to see rates at these levels for much longer. Hope you enjoyed this little video, and hope it was helpful. And if you have any questions, I'm always available to answer them. Thank you.